Welcome to this LinkedIn Live session hosted by Marvin Labs. Today's event, Credit in Transition, Consumer, Corporate and Private Market in Focus, puts the spotlight on one of the most rapidly evolving areas in finance, the structure, flow and pricing of credit. As interest rates remain higher for longer and traditional bank lending contracts are under regulatory pressure, we're seeing a redistribution of credit across platforms, asset classes and underwriting models. This conversation also brings together cross-sector perspectives to unpack where capital is moving, who is assessing risk, and what this means for both the equity and credit-focused analysts. From buy now, pay later, and private credit functions to Basel and AI underwriting, we'll dig into shifting dynamics around modern credit markets. Finally, we might also touch upon tariff impacts and a brand new real-time tariff impact tracker from Marvin Labs. But first, let me introduce Muntaha and Alex. Muntaha, would you like to introduce yourself, your background, and where some of your passions are in this credit space?
Yes, so I'm currently a Loughborough economics student in my penultimate year, going into my third year, and also the head of the Loughborough Student Managed Fund, which is currently the largest student investment fund there is, with around 300k of capital. And there we kind of manage a portfolio and write reports on it, kind of similar to what Marvin Labs do as well, but maybe on a slightly smaller scale. I've also worked with a lot of companies such as Scotiabank, Amplify Me, and Marvin Labs, and work in fintech to promote democratizing financial knowledge and to really give experience to students of working in finance, understanding the industry and understanding consumer credit, private markets, all that fun stuff.
Yeah, it's great. It's great you're here, and I really appreciate you giving your time to talk to us. I think democratizing financial markets, I mean, that's a really powerful topic. And I think, I look forward to hearing more from you in the next hour on some of the initiatives that you're doing, because I know you're doing a lot at Loughborough and wider on that. Alex, let me introduce you as well. Introduce yourself, Alex.
Yeah, hi, I'm Alex. I'm the founder and CEO of Marvin Labs. I have spent most of my professional life in and around investments and finance. Started my career on a credit trading desk at Credit Suisse, and actually spent a lot of time doing credit structuring, thinking through how banks should approach credit and credit risk. And doing some investing in private credit and on the equity side as well. And as of about a year ago, I founded Marvin Labs.
That's great. Just before we get into the questions, do you just want to explain a little bit about what Marvin Labs is? And particularly, I know the tariff piece is high on everyone's agenda. Something new that I saw come out recently around real-time tariff tracking.
Yeah, so Marvin Labs is an AI assistant for professional investors. And it's basically helping professional investors with the qualitative side of their work. So we, or our bots, our agents, consume all kinds of financial content, usually first-party content. So that's everything companies put out, from the annual report, quarterly reports, press releases, earnings calls, all the way to some marketing presentations, some investor marketing presentations in particular. And it's then helping investors make sense of it by a variety of means, including summaries, sentiment, allowing people to interact with the documents. And it's a tool that kind of complements the traditional quantitative focus that people have on companies. And what we've launched, I think late last week, is a tariff tracker, because obviously that's the big thing, one of the big things in the market. So what we're doing is we have an agent that is just looking through every earnings release that's coming out and is evaluating and exposing the tariff impact. We made it available completely for free on our website. I'm sure we can put a link here. And it's been a good success. We've had some very positive feedback on that. We want to extend that feature a little bit to give people the ability then to also interact with the with the results. So to have a chatbot interaction with the results, that's hopefully something we'll release this week. But we're kind of have this big tariff topic now that everybody's kind of thinking about as front and center, and we're seeing companies reporting $1 billion plus impacts on their operations from tariffs.
No, and when you think about this topic in the next sort of 50 minutes where we talk about it, that sort of the impact of those tariffs on things like inflation, interest rates, credit, etc. It all kind of flows through. We've had a couple of comments in so far, which is great. Thucker says he's excited for the next hour, so we hope to not disappoint you there. And Christian Ball has said, this sounds a really insightful event. Thank you guys and girls for setting this up. Muntaha, I'm going to come to you first of all, because we're going to ask a sort of first question here around what's behind the recent growth in private credit vehicles, and what should equity analysts in particular be watching in publicly listed asset managers, etc. So just wondered what your thoughts are on the current sort of credit market and private credit.
Well, I think there's a couple of things. I think a main one would be regulation, and also maybe the lack of trust over the recent years. I mean, it's not just been the 2008 crisis. There's been, many scenarios that have popped up with traditional banking system that has reduced trust of consumers. And I think everyone's kind of ready for that new alternatives to come to, and more adapted alternatives and flexible alternatives. And I think private credit is really making that happen, with not only just advice, but flexible plans, using floating rates instead of fixed rates, which is really helping with that unstable interest rate environment that you mentioned, and I'm sure we'll mention in the coming minutes as well.
Yeah, I mean, I'm certainly there with you on the, private credit growth driven, largely by regulatory constraints on traditional banks is certainly something I've seen. Alex, what's your thoughts on that question?
Yeah, it's an interesting development, right? Private credit has exploded in its popularity. A lot of it is really the decline of traditional banking taking part in this space, which is driven a lot by regulatory pressures. It's also kind of a willingness for private credit funds to do slightly more uncommon things, but what we've seen over at least the last 2 to 5 years is there's still going to be some standardization in the products that people offer, and there's only a small sliver for fairly innovative products. So that's clearly happening. It's a massive growth. It's a massive growth for a lot of asset management firms. And it's something that we're seeing kind of permeates the traditional boundary between the public and the private side, because it used to be that you're rather public asset management firm, think of BlackRock, or you were a private firm like a KKR, like a Blackstone, and I think what we've seen now for the first time is we're seeing in particular the public side going after private credit firms. And that's an interesting development, because you're kind of coming out of the world where the average margin on assets under management for a public equities firm in particular, somebody like a BlackRock, is low to mid double-digit basis points, and on private credit you have you have substantially more. You have high double digits, maybe you're even reaching triple digits. So it's a massive increase in your average income based on your AUMs.
I mean, I've certainly experienced firsthand, having been a former global head in HSBC, the effect, I guess, of to some extent regulatory constraints, but to others, perhaps, as you say, a pullback from this space, which has created, I think, that vacuum for that growth to really accelerate. And I think what I find quite interesting is the businesses that maybe more specialized niches starting to appear as well. I think that's quite an interesting angle, that there is more specialism than my time in the banking sector was far less specialized as niches. And I certainly agree with you on the margin piece, and I think any equity analysis, or analysts should be looking at margins, fee structures, and sort of credit risk disclosures, given the pace of change in this space. So yeah, and I think it's interesting. I also see it as one that I think will continue to grow, even though it's had significant growth so far.
Yeah, I mean, the traditional problem of everybody that is doing private credit has always been origination. How do you get the loans in your books, right? And that's where banking had a big advantage, right? Because you have like thousands and thousands of customer relationships. You're having massive operations. You're James, from your experience at HSBC, right? You're in 100+ countries with feet on the ground and everything, and obviously you have to do something for your loan origination, but like some of the loan origination just lands on your lap, and you have like people who do loan origination kind of as part of their other duties. And now if you're a private credit shop, right, you don't sell treasury services, you don't sell FX services, you sell loans.
Yeah.
And how do you make that work? How do you make that work sitting in an office in New York, in London, wherever, but you clearly don't have an office in some of the far-flung edges of the HSBC empire or of the Credit Suisse empire? So how do you do that? And I think the big development really is this sponsor-driven private credit, where you're basically giving your loans to a private equity sponsor or to the target of a private equity sponsor. So really, you solve your origination issue by just having a relationship with a private equity firm. And that's I think been really the catalyst. That regulation has been the catalyst. It's now like you fix the origination piece, and you fixed it by basically making it somebody else's issue, namely the private equity firm. But they have more margin to play around with, and there are a lot more of them.
Yeah, no. So we're talking here about credit availability. Mutahar, I think this is a good one sort of to come to you, a question around what do rising rates, or how do rising rates, I should say, affect credit availability for consumers, which I know is a topic close to your heart, and mid-market corporates. So what's your sort of thoughts on rising rates and credit availability?
Well, I think from my research, it's affected traditional banks, PE firms, and then fintechs quite differently. As I said, with PE firms, they have a little bit more flexibility with that floating rate lending, with the transfer of responsibility and risk among the insurers, the hedge funds, and it's also more longer term capital. This is capital that is not quite like deposits. And when I was reading over, I'll give you the name, the Professor Ludovic Filippo, if I say that correctly, paper that he presented, it's quite a long one, to the House of Lords Financial Services Regulation Committee. He kind of backed up that notion of, these PE firms don't carry the same amount of systematic risk as traditional banks, because it's not on short-term deposits that are highly affected by short-term rates. It's more long-term capital. So I would say it probably affects PE firms the least. I would say it definitely does affect traditional banks, but it also does affect those fintechs. If we look at Klarna, Klarna peaked in COVID, where with its buy now, pay later services, but then it dropped. I think it valued around 45 million in COVID, and then dropped to 15 million post-COVID. Why? Because of increasing rates. And Klarna don't necessarily charge high interest rates for its consumers. So they were protected in that sense. But they definitely did take quite a big hit on that. So in terms of credit availability, I think it depends where, who's giving out the loans.
Yeah, I love that name, Ludovic Filippo, wasn't it? I think That's got to end up one of my names of the year. I did actually see that report from the House of Lords, and you're right to reference that. I think we'll come back to that topic about credit risk and affordability through Klarna and others. But Alex, what's your perspectives on that piece around rising rates and credit availability?
Yeah, I think Muntai hit kind of the nail on the head here, right? It's kind of, I think the real answer is like, who cares? Because unlike banks, where if all of a sudden you're having some performance issue on credit, you'll have a trouble on the deposit side. You don't have that on the private credit side. Well, let's see, but we're all hoping that you won't have that. Same thing on the private credit side, and you clearly don't have it on the Klarna side, right? Nobody will bail out Klarna if they screw up their pricing, and nobody's going to bail out a private credit firm if they screw it up, because there's like, in almost by construction, no systemic risk, which is kind of a nice thing, and that's also why the regulator is kind of fairly relaxed about this, and I think why, as a society, we should also be fairly relaxed. I mean, who cares if they screw up pricing, and we'll see what happens in a true recession. But we've seen with COVID that one of the advantages if you don't have deposits is you can just extend you can extend your loans. You can suffer through this. You can you can take over a company, declare defaults without big issues. We've seen that a lot on the retail side, and it's kind of it is almost a matter of who cares about it, right? Even if you default on the private credit loan, right? You're taking over from a private equity firm that nobody has much sympathy for, and nobody has much sympathy for you as a private credit lender, from at least a regulatory point of view. And I think that's kind of, I think that's a good feature.
Yeah. I think it's a good point referencing back to COVID, because you think back then, effectively countries to some extent ended up being, balance sheet. Ended up actually becoming balance sheet was the country was backstopping. Many countries were backstopping lots of issues as well, and as you say, extending credit terms out. Some of them I don't think are even fully recovered from that time. We've had a question actually linked to your point about recession, which you just sort of briefly mentioned, on from Jacob Munro, that says, how do you see private credit performing if we enter a recession? I'll hand that one to you, Muntar, just to see what your thoughts on there. Hopefully the word if remains if rather than we are. But I'd be curious, what's your thoughts on that if we enter a recession? And obviously really that could be any country.
Yeah. Well, if we enter into a recession, I think how long term the capital is, like in terms of pension funds, insurance funds, I think that would mitigate a lot of that instant pullout and liquidity crisis that previous recessions have faced. We might see some collaborations between private equity companies as well to help mitigate any hits, but I don't actually think that private credit firms would get that badly affected by a recession. And when I said about collaborating, I know that there's recent articles of such as financial of Morgan Stanley collaborating with Blackstone synthetic risk transfers to help the reserves that Morgan Stanley have been holding. And so those kind of, working together and not necessarily taking on all the risk as one company would help kind of smooth out any risk that recession would kind of put at you. I don't know if that made much sense, but it's nowadays, it's not one company that holds all the risk. They definitely share that among a lot of different organizations and other PE firms or, hedge funds or investors.
Yeah, I think I think it's an interesting one in terms of, I guess, always trying to predict things with recessions is really tough, because I've seen some go one way and some go the other way. And I always remember Her Majesty the Queen of England and Ireland, Scotland and Wales, I should add, when we entered one of the big recessions in 2008, she said to one of her advisors, "Did nobody see it coming in this way?" And I think that's very perceptive. That it's often very, very hard to predict. Alex, what's your thoughts on if there were to be a recession type environment, or it were to accelerate? I think in some cases it's probably already here. What's your take on credit and credit vehicles?
Yeah, I mean, I think the big risk factor, the big unknown is like if we're, I mean, I was saying just 2-3 minutes ago, right? Nobody has big sympathy with the private credit lenders and the private equity firms. But if we're getting a massive shock to the quality of these credits, right? I mean, eventually, those are investments of pension funds, of other insurance vehicles, of other long-term investors. Like, what's going to happen if all of a sudden they are starting to feel an impact, right? What's happening to all the investors? Is this really long-term capital, or is this another glorified maturity transformation, as we've seen on the banking side? I think that's the big risk. And I mean, we don't have to forget, right? I mean, there's still a lot of traditional banking doing lending, in particular in like mid to SME space. So there'll be an impact on traditional banks as well. I think the theory is always, right, the private equity, private credit is slightly on the more risky side. I think a lot of the stuff that buy now, pay later lenders like Klarna are doing is on the risky side. But I think in particular for buy now, pay later, it's such a small sliver of anything that really, I think the broader impact is not going to be there. I'm quite pessimistic about what's on the books at Klarna. But I mean, the advantage of the model is they can clear their book in like 3 months time, because it's all so short term. So even if they lose the whole book, it's gonna be over after 3 months.
Yeah, I'm going to come to them and their model in a minute. We just had a question in from Srishti Shah, which is, in economies like India or Brazil, we're seeing credit slowdowns despite easing. What structural factors do you think are at play? That's a very interesting question. Alex, do you want to share your thoughts on what might be at play there? And I'll share mine, and Montana as well.
Yeah, sure. I think some of it is just it's just a bit of a pullback from global operations, right? I mean, we've talked about how difficult it is to originate credit far away from your headquarters, and I think we're seeing some of that refocus on core markets. We're seeing kind of a lot of the traditional larger banks, in particular, a lot of the traditional larger banks that are focused on emerging markets, like an HSBC. That have a big footprint there, aggressively pulling back, and I think we'll continue seeing that. So I think that's one of the structural factors, and you don't have enough of a local market coming after, and to me that's the big issue on that side. And then I think we've seen over the last 5 years, we've seen a bit of a synthetic, given the reaction lots of governments had to COVID. We've seen a little bit of a synthetic easing of credit conditions. Too much capital competing for too few investment outlets, and I think we're seeing some of that. But we're seeing some of that normalizing, right? It's not pulling back; it's just normalizing.
Yeah, I'd agree with you. I think, again, ties back to some of the questions about structural changes within banks and where their focus is. If you look at countries like Brazil and much wider, Paraguay, Argentina, Venezuela, all of them are experiencing similar challenges. And I think your point as well, that I was reading in the news today that HSBC's potentially pulling out of Australia. So it's not just some of the markets you might more traditionally have associated with banks like that, to see a major bank potentially pulling out of Australia as a market, albeit HSBC's already pulled out and sold its Canadian business and its US business. That in itself is quite an interesting a sign, I think, when you talk about structural factors. Muntara, what's your thoughts on this question?
I think you guys covered it mostly. In terms of those countries, I would say access to capital and the risk levels are probably too high that banks wouldn't necessarily lend as freely as they would in other countries. Although saying that, I'm not sure how big like microfinance is in India and Brazil, but if we look at countries like Bangladesh, microfinance and giving mini risky loans has actually paid off incredibly well and has continued to grow. And I know one firm, forgot the name, but I will let you guys know, hopefully, but had an incredible IPO and incredible returns just through microloans, giving loans to small businesses, small companies, agricultural companies, especially since the environment is Bangladesh. So I think there's two sides to that, but I would say the main answer I would give is the risk level.
Yeah, I think those micro agencies as well. I think you make a very good point about those. I just want to come back onto the sort of buy now, pay later sort of heavy topic, because the regulatory sort of chains are tightening around it all the time. You can feel that. But Muntara, do you think buy now, pay later firms are displacing banks and traditional forms of credit, or are they just extending credit cycles? Are they actually adding something new, or are they just another part of what would have traditionally been in the bank space?
I wouldn't argue that they're displacing banks at all. I say, if we look at maybe Revolut, they have yet to get a license to, get credit card and become a bank, which they did intend to do. I know that they have done so in other EU countries, but right now in the UK, they cannot do so. So they're probably not much of a threat. But I would probably agree that they somewhat do extend the credit cycle. I think we live in a generation where everything is so instant. If you think of like Amazon Prime, the internet, ChatGPT, you can get information, you can get items so quickly. And then if we look at consumer trends as well, they're more common, but there's more, diversification within those trends. Everything is so instant. So I think buy now, pay later really accommodates to that and is really on par. So I think it was always going to be a concept that was gonna, come around. And nowadays it's linked, it's incorporated in the checkout service. You can check out using your credit card, or just below, if you notice, there's always Klarna or Affirm right there ready if you don't have the money now. And as I said, it really peaked in COVID, where wages, money was uncertain, but also we were becoming a cashless society. But I would not say it's competition or displacing or replacing, but I would maybe agree that it extends the consumer credit cycle slightly more.
We lost James. Now we need to self-moderate here. Okay.
Okay.
I think
over to you, Alex.
I think on the Klarna side, realistically, right? We've always had consumer lending, whether it's like a loan to buy your TV or whether it's credit card lending, right? The kind of, I think one of the big reasons why Klarna is a European thing is because in the US you have credit card lending, unsecured, and that's your outlet to that's really your outlet to this kind of exposure. And the one thing that happens with credit card lending, obviously, it stays mostly on the balance sheet of banks. Mm-hmm. And with Klarna, it's on Klarna's balance sheet, and obviously some of that is passed on, risk transferred, is securitized. But Klarna continues to carry some risk, and I mean, Klarna doesn't have any deposits, so kind of it's kind of neat enough if they misprice it, it's just going to be them taking the hit, and maybe some of the securitization investors taking the hit, but it's clearly not a deposit holder that is really taking the hit on that. So that's at least kind of the big thing. I think, I'm going through James' question, and maybe as we're waiting for him to come back, I think there is obviously a question of how does the regulator look at these non-traditional retail solutions like a Klarna, right? How does the regulator look at that? What do they think about that? Like, what's your take on it?
How regulators...
How does the regulator kind of look at what Klarna is doing?
I think they probably...
What's your take? I mean, are they doing a good job? Or are they kind of...
I would say they're mostly looking at it probably as a fintech rather than necessarily a lender just yet. I know that there's, with regulation, I don't think it's quite the same as with a traditional bank. So I think they're probably still figuring out how really quite to regulate this whole scenario with fintechs and the more digitalized services, just as they're doing probably in like the crypto market as well, as that's trying to get into the financial industry too.
Yeah, I never really got the point why the regulator needs to care about this. And I think mostly the regulator stays out of it, right? I mean, I think you mentioned Revolut, right? Revolut is a funny story because they've been, battling for 5 years to get a banking license, and I never understood why the regulator cares so much about it, right? Like, even if they have terrible operations, right? The terrible operations happen on their balance sheet. It's their money to lose, and it's their investors' money to lose, and why would we prevent Revolut from making stupid business decisions, right? We're not preventing other firms from making stupid business decisions. So while it's incredibly funny that Revolut has been trying to get a banking license for 5+ years and still hasn't succeeded, I never really got why. Like, I never really got why the regulator cared so much about it to make it so onerous to jump through. Other than, I think, the regulator likes being in the news once in a while, and Revolut always throws a little bit of a fit when there's another delay.
Yeah, I think you've got a number of things at play, Alex, and you touch upon a couple of them. I think, firstly, the incumbent banking community, it's within their interest, as it were, to keep stirring up the regulator, so it's not just them that's constantly under pressure, and identifying structural operational risk at challenger banks is an easy way to do that, and publicly to do it. The second thing is I think a lot of this noise is actually driven more by the media and social, rather than actually the regulator itself. If you actually look at in lots of markets, but if I take the UK, if you actually look at the numbers of people working in the regulatory space, capable and able and resourced to do full reviews, it's minuscule. The actual ability and bandwidth to cover things is really constrained. So it's almost asking the regulator to get involved in everywhere, but at the same time, there's very little resource to do it. It's more media noise than reality. And then I think if you take the credit question and buy now, pay later, again, I'm with you on this, Alex, because if I look at traditional credit, kind of credit cards, for example, the revolver credit, there is nothing, at the moment, you've got them operating side by side. In some ways, somebody revolving credit on a credit card and then using a buy now, pay later tool to pay in 3 months. They're still revolving.
Doesn't make any sense, right?
Yeah, they're still revolving the credit on a credit card. Maybe the 3 months or full payment kind of structure is more disciplined for them. But, to get too uptight about it, I again of that view that there should be perhaps more interest in the amount of revolving balance transfers that take place. But I do know it has.
Sorry.
I was going to say, I do know it has become quite it's a bit of a hot topic, a lightning rod, where I don't think it should be as carefully examined as some other spaces.
I think you made a very interesting point, right? It's the buy now pay later kind of incentivizes different repayment schedules than credit card debt, and kind of I think here is really where the interest of lenders and the interest of the regulators are completely opposed, right? Because the lender, like every credit card lender will tell you, right, they love people having balances outstanding because they charge a crazy interest rate, and it is well above risk. So the credit card lenders, they don't want to have repayment schedules, right? They want to keep people in debt, and I think obviously it's a different regulator that we're talking about here. It's not a bank regulator, but I can understand why there is a consumer finance regulator saying, right, I mean, like make it kind of slightly more onerous for people to access credit, and make it so that they understand what the credit cost. And I think both things are actually areas where a modern buy now pay later is superior to a credit card lender, because a credit card lender will never tell you what their APR is.
No, and one of the challenges as well with the credit credit card is you'll have tiers of rates in there as well, depending on someone's risk profile, which again is more transparent. And I think the other point you made earlier, Alex, about balance sheet, that ultimately there's only a limited period of exposure, which is on a buy now pay later, compared to someone could be revolving hard credit card debt for many years on somebody's balance sheet. Interesting, we just had a question in from Melvina Metucci, which, if I spelled that right, sorry if I haven't. In this credit environment, how would you assess the role of IPOs? That's a really interesting question. Alex, what's your take on that one? That's a good question, Melvina.
It's a very good question. Do you mind if I just make like one last comment on this buy now pay later and credit card thing?
Yeah, sure.
Because obviously, like if you think about it from the perspective of risk profile, right? The big advantage of a buy now pay later is you shut down your doors now, and there's no new credit coming in, and that's it, right? That's if Klarna wants to shut down origination today, they just turn off their app, and that's it. The problem with any revolving credit facility, as everybody that has ever worked in corporate credit can tell you, is that a day before bankruptcy, everybody draws their revolver 100%. So you are kind of incentivizing the worst kind of behavior. You're incentivizing people to take credit at the point where they're the most riskiest. So you have a massive wrong way risk here, which you don't have in a traditional or in a modern buy now pay later. So I think that's kind of, I think, another reason why you should kind of be slightly more happy with that model compared to a revolving model.
Yeah, no, I agree with you. I've run several credit books for neobanks and HSBC, and I think it's always that question about the mix and the quality of credit, and obviously your long-term balance sheet management as well. But I just want to come back to that question on the IPO, the assessing the role of the Well, yeah, no, because I actually quite like it as a question. I think it's quite a really interesting question when you look at the current market. I guess it's more cautious. What's your thoughts on that, Alex?
Yeah, I think private credit is kind of a bystander to this. It enables private equity firms to hold longer onto existing investments and kind of keep companies private for longer. And we've seen a general shift to private markets, and we've also seen kind of parts of private markets becoming kind of slightly more public than they ostensibly are, right? If you're a professional investor and if you want to invest in like late stage tech firms, you can do it even if they're private, right? There's there's a kind of sizable chunky market to buy shares in SpaceX and stuff like that. So it's a broader shift, and I think private credit's role there is just, and it enables private equity firms to be in it for slightly longer, but I don't find a different solution. And it's more a general shift towards staying private for longer, because being a public company is getting more onerous and more expensive.
Yeah, I think there's a risk, I suppose, of liquidity bottlenecks. But I think for me, one of the things is the IPOs that do go forwards, I think will probably be more defensive growth kind of stock, not maybe as speculative, not as many speculative tech names, and more maybe healthcare, that type of stuff. I think that's would be my take on what would go forwards more, and maybe a bit more selective than it would have been perhaps previously. And what do you think, Mintara?
Yeah, I mean, the underwriters get paid on the spread, don't they? And they get paid on, that initial spike in that stock when the IPO goes through. And so if you're, doing an IPO in an uncertain environment, I agree with both of you. Like, it's you're not going to get that right type of speculation. You're not going to get that initial pump, and so it's probably going to really struggle. Not even necessarily related to how good the company is, and has built up to. So yeah, I would agree that a bad credit environment, a bad economic environment would not be the most beneficial for an IPO.
No, I just want to swing direction slightly, because we've talked a lot about credit, buy now, pay later. We've talked about some of the trends, tariffs, recessionary impacts, etc. I just want to swing into your experience, Mintara. You mentioned early on about democratizing, finance and being a part of that. And I just wanted to touch upon, if you could share a little bit of your experience organizing financial and non-financial events, and how they support people and performance. I think that's a really interesting perspective on all the topics we've just discussed around credit.
Well, I think something about the financial industry is it's very stigmatized. And then there's this kind of finance bro persona that people think they have to fit into or have to make it in the industry. And I think that holds a lot of students back. And, talking to my friends when I initially wanted to step into the finance world, is they said, no, like, you're a good person. You're a fair person. You would never, scam people, and you're not money hungry and all that, because that was the stigma of the entire industry. But the world doesn't function without the financial industry, and it's not just about earning money, having that penthouse, but that was the stigma. And so with our financial inclusion events, it's really making sure that people understand that you just need that common purpose of, you're passionate about it, you want to learn more. It doesn't matter kind of what stage you're in. And in my investment fund, we have master's students, we have people that have just come back from placements from Goldman Sachs, Blackstone, Barclays, and we also have first years all combined into one investment fund and all working together. And I think giving them the same platform, giving them the same resources, and having them being able to use one standardized report that we've given them, fill that in, and then hand it back to us and post it on our LinkedIn together, has really made people feel like they are included, no matter what knowledge stage they're in, and no matter who they are, they can work together in one community. And especially when it comes to, again, with finance, it's so easy for certain people, let's talk about nepotism. Like, if your parents are in the industry, it is a lot easier to understand the financial industry. You can go to your parents and gain that experience, take your parents to work day, and there's nothing wrong with that, but it gives people an advantage over others. And it's so hard to understand, some of these words that we've used. And so another aspect of democratizing financial knowledge is just exposure. And I don't know if you guys have ever heard of Amplify Me.
I have, actually, yes.
The trading simulator. Yes, so we've worked with them quite a bit because they have the simulator where you have 20 million portfolio, you have 3 asset classes, cash, bonds, and equities, and live macroeconomic news that the simulator gives you, and you're all in a room. There's about 100 people in a room. You're all starting from the same 20 million, and you're all off with the instructions and the live news, and it's popping, and it just gives everyone an opportunity to not only feel included, but kind of show off their skills and show that they can do it no matter who you are. So that's, I would say, it's the core factors.
Yeah, I like your point about people gravitating towards where their parents worked. I'm mindful of, I was thinking my dad was part of the team that worked on the chemical coating for the space shuttle, which is, I think, a really cool thing that he did in his career. And I was just thinking about Alex's point about SpaceX earlier, that maybe I've missed my vocation down there. And I think often when you make a point about the ethics around banking and finance, and I'm always mindful of a quote by Peter Drucker, which says, profit is not the purpose of the business, but rather the test of its validity. And I think, there is nothing wrong with making a profit. Absolutely. That's what most businesses, including the financial services sector, should be striving to achieve. It's how you do it and the validity of the business that's doing it that I think is important. Alex, what's your take on that point about ethics, finance, and also people entering the profession?
Yeah, I think Muntara has a really, really fair point, right? It's there's a big dichotomy between kind of people that have a background that exposes them to finance and that have a leg up in the game, and people that don't. I mean, there's unfortunately still a lot of people in finance that look, James, like me or you, and that's clearly not all skill based, and I think that's a big challenge of the industry because it keeps the industry kind of fairly unattractive, I think, and it is a talent shortage to the industry, and I think we are having fintechs has clearly helped, right? Making it more accessible to people with a bit more tech background. We're also seeing a massive technologization of the industry, where more and more roles are going towards tech, and it's still, it's still a worthwhile career. I think it's still something that people enjoy, and I can personally say, right, the first few years in banking are fantastic. It is probably the best learning experience you can find if you're curious about the world and curious about numbers. But I fully appreciate Minter's passion about making this more accessible to wider groups.
Yeah, I think, just a bit of a personal feedback. My daughter came into a bank and went into the trading floors. And if you can imagine what that was like, entering one of your first roles into the trading floor, she found it quite, I think, traumatic. Probably wasn't even a strong enough word for it. It was really tough. It was really tough, and you do have to question the environment. Hopefully, though, Alex, as you say, people don't look like me in the industry anymore. I think someone described me once as a weary camel. So I'm hopeful that there aren't that many people out there who look like me joining banks. So, but anyway, Muntara, on your experience as well, just while we're on the student side of things, you're leading a student managed investment fund. What are the ways that fund equips students with experience, given we're talking about people coming into the industry, and how do you think that they can use the experience of sort of the investment fund to take into intern type roles? What's your thinking on that? I'd love to hear what your perspectives are. And we've had Shrishti Shah has said yes, so I'm not sure whether that was to my reference of myself as a camel or whether that was to your point.
No, it's definitely not.
I think I'll go with it being Alex's. Alex's one. So thank you, Shrishti.
Yeah, I would say it's a great addition. And I think I remember you, Alex, you did an economics degree, didn't you?
Yes, I did.
And you said it wasn't very applicable to your financial career. Was I correct?
It's, I mean, I wish I would have studied physics or math. But yeah, I think it's, I mean, there are different routes into banking. I always tell people and ask me that I think the biggest differentiating skill in banking is, in most of banking, is actually solid accounting knowledge. That's the one skill you really need. Everything else is kind of acquired and you learn on the job. But solid accounting knowledge, I think, is tremendously helpful. And I'll always recommend that people that want to go into banking book up on their accounting knowledge.
Yeah. Oh, go on. Sorry, you go, Mintal.
No, you go first.
I was just going to say the point about the one thing I took when I first started in banking and finance was to learn the basics of balance sheet management, because absolutely everything boils back. You can have all these different vehicles, derivatives, all sorts of different variations, assets under management, but ultimately it comes back down to how well does an organization manage its balance sheet.
Yeah.
And so this was why I was asking this was, sometimes the degree isn't comprehensive enough, to cover the essentials that you're going to need taking into placement and internship, or doesn't really give you that exposure. Learning from a textbook in finance and then going on to do my interviews for Find Your Place in Finance, there's such a difference. The world has changed so much from those textbooks, and so much is not really quite relevant. So what I love about this investment fund is not only does it give students the ability to have kind of more tangible experience without maybe having prior internship experience, which is so competitive nowadays. It's so hard to get an internship, a placement in the job market. I know you guys have previously talked about, but it is quite tough at the moment. So this exposure to experience, to work in a community, to learn from people who've come from placements again, has really supported others from also getting a placement. Having that on your CV that you've helped manage a lot of money, and also you get work out of it. You have your report in a standardized format, and we really make sure that referencing is done correctly and everything's legal before we put it on LinkedIn. Like, we have also recently made sure that we're not taking screenshots of other people's graphs. So like, maybe a year ago, it was more you took a screenshot of a Financial Times graph and you'd put it into your report. And so now we're kind of more pivoting towards finding your own data, using Excel to present the data, making it nice and purple for Loughborough, and then putting it into your report. So I think it's that support and guidance that's really helping people get placements, but also just the name, and it's also very special because the profits that come from this fund go towards student scholarships as well. So it kind of indirectly also helps other people get into university, then get into those placement roles that, before that maybe couldn't have afforded to go to university.
No, I think that's very, very important. I just want to clarify here, Shrishti Shah, thank you for your kind comment. You have clarified that the yes earlier was about Amplify Me and the Student Investment Fund. As she said, she was also enrolled in one and was lucky enough to have done an equity research. So thanks for that, Shrishti. But obviously the camel is still out there, but thank you for clarifying that point. We've only got about 5 minutes left, and time flies on these. I do want to touch just upon people's thoughts, both of you, on where does AI fit into the modern credit risk assessment around underwriting, monitoring, etc. Just wondered, Alex, I'll come to you first, because obviously Marvin Labs close to your heart and what is being developed. What's your take on what role AI perhaps has to play in this?
Yeah, I think credit, more so than equity, is a game of consistency, structured analysis, and basically getting more things right than wrong. And I think one of the things AI does is just it creates very consistent analysis. It will always get you, a good credit memo if you kind of set everything, if you have everything set up right. It will get you a good credit memo, and then you can take that good credit memo and make your decisions based off of. And really, this is the promise of AI, is that you'll help with the analysis. You help with the kind of, in particular, with a non-financial part of the analysis, and you do this kind of in a scalable way, because fundamental challenge of credit is always it's hundreds of names. It depends a bit on what exactly you're doing, but if you run a consumer books, it's literally a millions of names. If you're on an SME book, it's still like massive amounts of names and so little time to dedicate to that. But even if you run like large scale private credit, you still have a smaller due diligence budget than the private equity firm that is doing the deal. So just helping out there, helping with your research, helping with your reports is tremendously helpful, and I think that's the big premise that and promise that AI has in space. And I think I understand that there's a lot of regulation around it that makes adoption sometimes slightly tricky. But I think for people that are willing to work with, that are willing to make the work and make it work in the organization, there's going to be tremendous potential, because, as I initially said, right, the big crux of everything in credit is origination.
Yeah. Muntaha, what's your thoughts on AI? And also, what do you see as a student fund? Do you see people using tools? Do you see people embracing AI in the world you're in?
Yeah. Well, I think, going back to efficiency and having things quickly done and go in the age we live in now, I think AI is giving so many companies that competitive edge. I think it's giving, fintechs that competitive edge over traditional banks in terms of underwriting and how long it takes to underwrite now. And I think AI can definitely support that in terms of preventative measures, predictive measures, and analysis and building reports. Which building reports, it sounds like it's quite a quick task. It's really not, and it's there's little bits and organization and presentation. In terms of AI, definitely, I assume everyone uses AI for their reports, but it's to what extent and how you're using that AI that we would probably look out for, because being a student investment fund, the main core objectives is understanding. We want our analysts to understand what they're writing and what they're putting out and have their own opinions, because it's so easy with AI to lose your own opinion. You ask AI a question and it gives you this very standard response, and you adopt the response and you regurgitate it, but then you lose your own voice and your own opinion and your own take of things. And so it's finding that balance with the investment fund, but we definitely don't forbid AI by any means.
I think it's very sensible, right? Because in the end, the industry uses AI, and I think one of the additional, I also was part of a student investment fund, and one of the big advantages that this gives you is it gives you exposures to the tools of the trade. And it gives you exposure to a Bloomberg terminal, to an Excel spreadsheet, to kind of basic modeling tasks. And I think if you're picking up some of the tools of the trade, that's always helpful, because that's expected of you, right? You walk into a bank and it's expected of you to know what a Bloomberg terminal is. You don't have to use it perfectly, but you should at least know what it is and kind of roughly what it does.
That's great. And that's a good time to bring this event to a close. We're up on the hour. It's been a terrific hour, Alex. Thank you for your insights. Muntaha, it's been excellent listening to your perspectives as well as the student fund information. That's been really insightful. Hopefully the audience has found this event, where we've covered credit in transition and looked at consumer, corporate and private markets, insightful. And we'll finish with Umama Alam, who's a student at Beaumont, said amazing insight. So that's a great way to end an event, gives us a lift, and hopefully the audience found the same, as well as, if you haven't read Ludwig Philippo's, because I wanted to say that one last time, House of Lords report, you should do so. So thank you, everybody.
Thank you so much. Thanks for hosting this, James.
Thank you.
Bye-bye.